Hello everyone. This is a webinar of MLI, Machine Learning Institute Certificate. My name is Zhdankin, and we are going to discuss today applications of reinforcement learning in finance. Please feel free to ask questions or ask any technical questions about the technical stuff in the chat. We will try to address them online. Today's topic is more about applications and more about the problems in finance and how can we transfer these problems into reinforcement learning settings. We are going to focus on the applications rather than the solutions for that applications. So because reinforcement learning is pretty much not easy stuff, and quantitative finance is even more difficult stuff. But we'll try to keep it simple. There are some questions about our audio. Is this fine? Okay. It's fine. So we will start with an overview of a reinforcement learning setting, and then we'll discuss how the reinforcement learning is applicable in finance, and then we will go through the few of applications. Two of them will be about the microstructure, and the last one will be about the hedging of derivatives, in particular options. So reinforcement learning is obviously a little bit different from unsupervised and supervised machine learning, in the sense that the reinforcement learning helps us to make decisions and choose appropriate actions in some uncertain environment. So normally in reinforcement learning we have some decision maker which chooses actions, and these actions will bring us some rewards. The decision maker is called agent, and the goal of the agent is to learn the best actions for different states of the environment. And the goal of the reinforcement learning is to find the optimal policy. The policy is just a function which maps states of the environment to the actions which agents need to make. This general settings of reinforcement learning, and it's quite applicable in finance, because we can replace the agent, the word agent, by the word trading bot or any trading entity, and that trading bot or trading entity will be making decisions in some uncertain environment, which is essentially a financial market. And the goal of such trading bot or entity or trading desk is to maximize P&L or to minimize the risks. So this is very applicable settings for finance problems. Yeah. So, and again, agent in finance can be trading bot, which goal is to maximize risk-adjusted P&L. At the same time, it observes some states, and states of the environment in finance can be market conditions, prices, trade conditions, maybe some microstructure, limit of the book, so something that we observe from financial market. Or if it is, let's say, a person who has some accounts in the bank, the person could be an agent, and the state could be the state of the funds or state of the account within the bank. Yeah. So, but in finance, we often operate with time series of prices, time series of observation of some risks or funds in the account. So often, to highlight that fact that we're working with time series, we include time to maturity or time to expiry into this state. So typical example would be we have some price, current price of the stock in our state, and on top of this, we include time to maturity of the option in the state, because the agent or trading bot should be aware of the fact that we have some expiry along the way. Yeah, and again, the agent should learn some actions according to some rules. So the actions could be submitting the order, sending some trade to the exchange, or update the bank account. So some interaction with the environment. Yeah, and then this famous diagram about responsible learning can be easily translated into the finance settings. Agent is our entity, and environment is our financial market. So the agent performs some actions, interacting with the environment, and then environment returns the reward. I guess so far it's pretty much clear correspondence between finance and responsible learning, but if you have any questions so far, please feel free to ask in the chat. This is the only option for you to ask the questions, is just to ask in the chat. Okay, so and maybe a little bit of how responsible learning is different from other machine learning techniques, including supervised and unsupervised learning. So objective of responsible learning is to choose the best set of actions which will lead to the best cumulative reward. Whereas in supervised and unsupervised learning, we need to classify, to predict, or to find some patterns in the data. So in responsible learning, we have environment which is uncertain. We don't know how the rewards are generated. The only way to know is the only way to learn this is to basically make the agent to learn the environment by interacting with the environment. But in supervised and unsupervised learning, we have the input data and output data, and we know the environment in which we operate because we know the labels or we know the underlying data. So training process in responsive learning is a bit different from supervised machine learning or unsupervised machine learning because we have to explore the environment. The agent should take different actions and define those actions which lead to the best rewards and correspondingly find the best policy. But the unsupervised and supervised learning is more about finding the best model, the best mapping between inputs and outputs. Yeah, and dependency is slightly different. So in reinforcement learning, obviously the next reward are dependent on previous actions and all previous steps that we've taken so far. Because if we move in one direction, obviously this will change all the potential future rewards because we are moving in that direction. Yeah, but in supervised and unsupervised learning, the data points may not or may be correlated with each other. We don't know. We can model the dependency explicitly. Yeah, this is just maybe huge difference between reinforcement learning and supervised and unsupervised machine learning. So if we think about environment as financial market, we need to understand that the policy that we need to learn, optimal policy that we need to learn, is basically a function which maps state of the environment to the actions. And what determines the policy is essentially environment. Yeah. So environment returns positive rewards, positive P&L for some actions, or zero or negative rewards for some actions. And this is how we understand which actions are the best ones. Environment again is uncertain, and the laws of financial market is uncertain. So the agent has to learn what are these laws, what the underlying structure in the environment which returns particular rewards. And the agent should always balance between exploration and exploitation. We always should explore different actions and try to find the better ones. But exploitations mean when we try to exploit whatever we found already. Yeah. So in reinforcement learning, we model environment as MDP, which stands for Markov decision process. So maybe the most challenging part of all this reinforcement learning development exercise is basically to model the environment, because normally it's quite complex object which returns some rewards as a response to some actions, and it's not just simply trying to find the mapping between inputs and outputs. So first we have to model that environment, and then we have to develop an agent which will be learning from interacting with this environment. But environment should have some properties, and we have some assumptions on the environment. We have all these assumptions in order to apply all these standard techniques in reinforcement learning for finding optimal policy and optimal Q-value function, and so on. So, for example, there is a Markov property of the environment, which basically means this equation here, meaning that the best estimate about the future is essentially embedded in the present. Yeah. So whatever we can learn about the future is embedded in the present. We don't need to go in the past. So basically, this condition means that if we observe current state, this information is enough for us in order to make optimal decision for all the future potential paths. We don't need to look backwards and ask what was the previous state and state before that. The current state is enough. But we will see later in finance, but this property may not be true. So we need to be very careful with this assumption. The steps in environment are the following. So we have some state, current state. The agent will choose some action, and then the environment will return some reward. At the same time, we'll move to the next state. Yeah. And the reward will be dependent only on the current state and the next state. Yeah. So the Markov property is hidden here because reward depends only on the current and the future state. There is no dependence on the previous state. And we in finance, it's often not the case. We can have dependency of prices. We can have a huge autocorrelation in prices, weak dependency. So when we actually need to go in the past in order to understand the future. But here, the assumption that we don't need to go in the past. The current, the present is enough for us to understand the future. If we think about the Markov decision processes, there are a few examples in finance which are well known. For example, is a random walk is a Markov process. The random walk is a Markov process because knowing current state is enough for us to learn about the next state, because simply the next state is current state plus some white noise. And similarly, the Brownian motion is Markov process. Yeah. So in order to try to understand the next point on the path, we don't need to know the past of that observation. We need to know only current observation of this path. Yeah, but if we think about the more practical application, let's say the today price of the stock is $100. Yeah. So how would choose your forecast? So the first case is that yesterday the price was $50, and the day before yesterday the price was $25. So your forecast for tomorrow may be different from the case when yesterday price was 150 and the day before yesterday the price was 200. Yeah, obviously there is a trend upwards and there is trend downwards. So for some of application in finance, knowing the current state is not enough to make reliable action and optimal action in current state. So we're going to be really, we need to be really careful with that assumption. So yeah, but on the other hand, we need the Markov property because this simplifies the exploration of the environment, and we can use some of the techniques like dynamic programming techniques. So we'll be assuming in our application that the process environment and evolves using the Markov property. Yeah. So because we can define our policy as a function from current state to action, and this function depends only on current state. And we know, and we will know that this function, we can find the optimal function, which maps the state and to the actions, and this function will be optimal one across all possible policies, including stochastic policies. The stochastic policies is the case when we we have some distribution over potential actions which we can make given the current state. So yeah, one way to avoid violating of Markov property is to include more and more potential observation in the past into the current state. Yeah. For example, it's just a hypothetical example, but we could include past observation of the price into the current state. Yeah, if we think that the past observation of the price is relevant for the current state and for the optimal action. Yep. Is there any questions so far on Markov property of the processes? Okay, cool. Some annotations that we will use. The general notations, but we will use them in our applications. So we have a state, we have action, and we have reward. we can have transition probabilities, which mean basically what are the probability to move to particular action and get particular reward, given we are in current state and taking particular action. And the expected immediate reward is just a mathematical expectation over all possible rewards, given we are in current state and given we are making particular action. So basically, this is a function of the state and action. But we are, as agent or trading entity, we are interested not just immediate reward. We are interested in cumulative reward over time, because we want to maximize over all possible set of potential states we will encounter, and we don't want to pay attention only to the next reward, because maybe next reward, there are some cases where next reward will bring us a huge P&L, but the rewards following afterwards will bring us a hugely negative P&L, and on average we will get a hugely negative P&L at the end of the day. That's why we are focused on this quantity, which is essentially cumulative rewards up to the terminal time T capital. There are episodic tasks, there are continuous tasks, meaning that in episodic task there is terminal state where we terminate, there is final reward, and continuing task meaning that there is infinitely many steps we can do, and there is no terminal state. And normally in finance or in reinforcement learning, firstly we have some discount factor gamma, meaning that we are maybe more interested in present rather than in the future. At the same time, this discount factor helps us with discounting infinitely, I would say, the rewards which are far away from today. Yeah, and in finance, we'll often use the simple discount factor for this gamma. Yeah. So these just notations, some general notations for responsible learning. Yeah, we just talked about the gamma, and often we have the state value function and action value function. Just as a reminder, the state value function is a function which basically brings us expected reward if we are in current state S and we are following some policy P, right? If we are in current state S and the policy tells us go left, then go right, then go left, expected reward of this policy in following this policy is what is the value function in this state. Action value function is the same thing, but we also add some action. So if we take in current state, if we buy, and then after we buy follow the prescribed policy, what would be the average reward? Yeah. So let's say we are flat and the action is to make market order to buy, and then afterwards we follow the actions depending on which states we end up. We follow the policy, and we average all the rewards coming from that experiment. That would be our action value function. And what we are interested, what the agent is interested in, is try to find the optimal policies, basically, which brings optimal policies brings us the optimal state value function, meaning that for all possible states in the environment, our state value function will be the largest one, right? So it's compared to all other possible policies. This is again general settings of response environment. And let's switch to the applications. But before we go to the examples, maybe for those who are not that aware of the microstructure, let me say a few words about the how the markets, high frequency markets work. So this is called microstructure. We have so-called limit order book in a given moment of time. We have some people on this side who are buying. Yeah, these are people buying at that price level. All these people are buying at lower price level, and so on. And people in blue are basically doing the opposite. They are selling. And obviously, people who want to sell, they normally sell at higher price than people who wants to buy. Yeah. And these levels basically level of prices. So these two people who are buying here and selling here, this is called top of the book. So or best prices on bid or best prices on ask. Yeah, the whole bunch of orders and prices at given moment of time is called limit order book. And there are different kind of orders the agent can make. The agent here, I mean the trading desk or market making bot, or someone who is trading in this particular exchange. So there is market order, which basically cross the spreads and they swipe liquidity on the opposite side. So, for example, you can see here there was a large sell order. So someone who was sitting here decided to go and sell to those guys who are buying at this price level. And basically, there is no liquidity now because there was a trade between those participants. There was a large sell market order. And then after some time, normally there is a recovery to another price level because other participants may come and join the queue here, maybe not here. And this is how the markets evolve. But also these queues here on sell side and this queue here for people who are buying, these queues consist of the limit orders. Basically, if you are a market maker, you put your limit order here on the bid side and put your limit order on the ask side. And the idea of market maker is to collect the spread. So we are buying and selling at the same time while collecting the spread between the ask and best bid. Yeah. And there are some notions like market impact. So you can see obviously there is a change in mid price after a large sell order. So this is called market impact because someone comes and make large sell or market order, causing the liquidity from the market disappear. That's why he is shifting the prices. And this market impact may be not in favor of us, yeah, because we can have some liquidity, and the change in the mid price may impact our portfolio and the revaluation of our portfolio. Yeah, this is just general settings of how the market evolves in very simplistic terms. And you can see that this microstructure is a perfect setting for the reinforcement learning, because we have very complex environment which evolves according to some laws, and the goal of the agent is try to maximize its P&L essentially, or minimize the risks. The agent in this case is market maker, or we will see also those guys who basically try to execute some orders. So we are one of the participants in this market. By the way, modeling of such environment is a very non-trivial task, because there are different assumptions we need to make of how the prices and the limit order book evolves, and these are not just one process. We have many layers of prices. We have many participants, so you can see it's quite complex task to model this stuff. Yeah. So, but let us now focus on some of the problems we can set using this microstructure. So, assume we have an order that we would like to execute at minimum costs. I mean, someone comes to us and tell us, could you please sell this amount of stocks within, let's say, 5 minutes or during one day. Yeah, given this environment as a microstructure. So one option for us would be to go and sell everything immediately. Yeah, to make market order and sell everything immediately. But that would result in some cost. Why? Because if you notice, if we sell here at this price level, this will cost. We are selling at lower prices than we potentially could sell at this level. Yeah. So potential P&L from selling using market orders is lower because of the prices. Because the prices are lower, but at the same time, there is always liquidity. We can always, I assume we can always, but normally we can always make this order. We can just cross the bid offer and make this trade. Yeah. So one cost for us is the bid-ask spread. So we are crossing the spread. Another cost for us is that there is market impact. The more we sell, the more we ship to market, and other participants may change their order, cancel their orders, and go deeper in the book, thus making us to make the trade under prices which are not in our favor. So there are many costs when we make the large market order. On the other hand, what we could do, we could split our initial amount of stock that we need to execute into small limit orders and execute them over time. Yeah. So we could put limit order here, then we could wait until that is executed, and then put one more again here. So you can see that the price levels are better in this case, but there is probability that we will wait too long, right? We have a limited amount of time to execute the order, but under some market conditions, we can wait too long, and our limit order will not be executed for a long time. So you can see there is a trade-off between making market order immediately, which will cause us a lot of cost, but we will know that we will execute it for sure. Or another option is to split the order in many different limit orders and try to execute it gradually. And this is again a good setting for reinforcement learning agent to find the optimal strategy, how to split the order and which portion. So if we move to the more formal problem setup, in reinforcement learning we need to define state, we need to define action, and we need to define the reward. And these state and action and rewards should satisfy the properties that we just imposed. So, for example, in our problem here, the state, current state, would be a vector of two numbers. The first number is how many shares is left to execute, okay, and how much time until the end of execution. Yeah, this is our state. There is terminal state, obviously, because we have final period when we need to execute all the stocks, all the shares. And if in the final state we don't have, we still have some shares left, we are forced to make the market order. Yeah. So again, the idea is try to execute the orders before the terminal state, because if we have something left, this will result in large costs. Okay, this is our state, current state. The action at each timestamp is amount of shares we are sending for execution and the level at which we would like the shares to be executed, level of prices. So again, we can send market order, meaning that for sell market order, it will be the best bid level or lower. Or we can send limit orders at the ask level. We can send the limit orders at best ask level, second best, and so on. Yeah, in case of selling, the higher is the price, the better for us, right? Because we are selling at higher price. However, if we are selling at higher price, the probability of execution of such limit order is lower because the trading happens normally at the top level of the book, best bid and best ask. Okay, and the reward is essentially our P&L. The reward is basically this quantity here. It's just number of stocks of shares which we have executed times the price, change in price. Yeah. By price here, I mean the price of the corresponding level that we put our order in, and we should have some kind of benchmark. We're comparing our price against some benchmark. In this case, we can choose mid price, yeah, and this will result in some P&L in case we have some order executed. So again, we have current state is the amount of stocks left to execute in time to the end of the execution. We have action, which is basically number of shares and level. We are sending our order, level of prices, and we have corresponding reward, which depends on the environment, yeah, and on the action and on the state that we just defined. So yeah, and basically these are the settings for that problem. Yeah, we define state, we define the action, we define the reward, and then we can try to simulate the market, or we can use historical data, try to find the optimal actions in every possible state that we encounter. Again, this is just problem setup. We are not covering the solution for that problem. Are there any questions on that particular problem so far? So I can see the chat, but is it
no.
for everyone? Okay.
No, there's been lost now.
Okay. So the policy for this problem would be finding the function which maps current state and action. Current state again is this quantity here, and action is this quantity here. Both are just vector of two numbers. And then solving for optimal policy, we'll find the best action for each of the states we will encounter. Okay, this is a problem for order execution. Market making problem. As we just discussed, again we operate in microstructure, and market maker. We assume that market maker, what it can do, it can post limit orders on both sides of the limit order book, and also market maker can make market orders to close positions. The goal of market maker is, again, to sell and buy at the same time and collect the spread between the prices. So the good situation for market maker is that when we have low volatility in prices, but we have high volumes on both sides of the book. So we just always sending some orders and collecting the spreads, while the prices are not moving against us. And the bad situation for market maker is that when there is high volatility in prices, but not enough volumes. So in case there is volatility in prices, there is kind of situations when we make a trade, and these trades are against us. Yeah. If we are buying from someone who is making market order, and this participant who is making market order is informed participant, and she knows that the price will go down. So if we buy from her, we get long position, and the price will go down, and then we are in worse situation, as compared to the situation if we don't do this trade. So this is a problem of adverse price when we try to avoid those trades against informed participants. At the same time, as a market maker, we would like to manage our inventory, because if we accumulate the large positions, we are very sensitive to the price volatility. Yeah. So you can see the market maker has a lot of things to take care of, because we want to maximize our P&L, and this P&L depends on many aspects. There is a question on how to find the optimal policy for optimal execution case. I will discuss one approach in last example, but as I said, this talk is more about the problem setting. So there are different methods how to find the optimal policy. We will discuss one of these methods in the end, and this method will work for case with optimal execution. But it will take a bit of time to discuss all these approaches for in reinforcement learning and how to find the optimal policy. But maybe generally speaking, there are a model-free method and model-based methods. Model-based method is based on the probabilities or on the assessment of probabilities of transitions from one state to another. That's why it's called a model-based method. And model-free methods, which we'll discuss later, are not assuming that we need to know and or estimate these probabilities. It will learn directly the optimal policy. Yeah. Sorry, maybe this is not really a good answer for your questions, but we just don't have much time to discuss the approaches. The question now is, can I elaborate on the state value function and action value function? Yeah, sure. So, state value function depends on current state and depends on policy we are following. So now we assume that we have some policy, which means basically mapping between state and action. So we know in which, for every state, we know which action we need to make. This is our policy. And the state value functions is simply, if we are in current state, what is the average reward from this state following a given policy? Yeah. If the current state is this level of prices and that position, that inventory, and then our policy is that we need to buy now, then we need to sell, then we need to make market order, and then something else. If we follow this policy, what would be our average P&L? Average P&L. The optimal policy will result in such state value function, which is which is larger, or at least not less than any other state value function for any other policy, for all possible states. This is called optimal policy and optimal state value function. And the action value function is a very similar thing, but in current state, we are also forced to make some particular action. So the state and the action are given. We are standing here, and the action tells us to go right. And after we, in current state, and after we are going right, then we follow the particular policy, given policy. Yeah. And what would be the average cumulative reward if we, in current state, make that action and follow afterwards that policy? Right, so this is kind of assessment of how good the state is and how good the particular action is. This is action value function. And again, the optimal action value function should be better for optimal policy, should be better or at least not worse than any other action value function for any other policy. And the model free reinforcement learning will learn directly optimal state value function and optimal action value function. Okay, let us get back to the market making example. So yeah, we are market maker, and we are trying to operate in the microstructure environment, submitting the buy and sell limit orders or making market orders. Let us now put this problem into the reinforcement learning environment, reinforcement learning settings. So we need to define our states, actions, rewards, and policy. Actions, what the agent or market maker can do is it can place cancel or replace the orders of a given size at a given level. Yeah. So we have the action. We can put the orders at given level of given size. Yeah. In general, what we observe is we observe the limit of the book, which basically all levels on ask side, on all levels on bid side, and correspondingly the prices and how many people at each price level we have who wants to buy or sell at that price level. This is the whole limit order book. So in general, we can define our state as current limit order book, which is denoted here, and also our inventory. So how many orders we already accumulated? Are we buying or are we long? Are we long? Are we short? Or maybe we are flat. And actions would be the posting the limit orders at given of given size and a given price level. This is in general settings. But for this particular example, we can define a slightly more simplistic environment. We can define that we have only best bid and best ask. We have state, which is represented as current best price on ask side, current best price on bid side, and also imbalance. Imbalance is simply a ratio between volumes on ask side and on bid side. So here we define the liquidity imbalance as ratio between volume on bid side divided by the sum of bid and ask. Yeah. So this quantity here is between 0 and 1. And if this quantity, which is imbalance, is closer to 1, meaning that there are more people sitting on the bid, meaning that more people are buying rather than selling, sitting at the ask. In such a state, we can define our actions as make the order, limit order at the bid, that is buy, make the limit order on the sell, ask, or just do nothing, just pause. Yeah. Obviously, in more generic terms, you can include market orders, different levels, but this just to illustrate the policy and the reward. Yeah, and for simplicity, we are not allow the agent to accumulate each position. So the position could be short, long, or flat. Yeah. If we previously have bought something, we cannot buy more. We can only sell or we can only stay. Yeah. So we are limiting our actions. We are limiting what we can do depending on the state. And one of the assumptions we're also making about the environment is how we simulate the orders being filled. So assume we put the order on the bid side or on the ask side, how to simulate that the order is being filled. This is a big question actually. But it's actually a reasonable assumption to make the probability of the order being filled be proportional to the imbalance. Yeah. So meaning that if we make limit order and on bid side, and there are many people who trying to sell as compared to people who are trying to buy, there is more probability that actually the order will be filled. Yeah. This assumption is required in order to simulate our environment and simulate actually our rewards. So the policy in this case would become this matrix. So we can have state, which is basically short, flat, and long. This is our current inventory. And actions are bid, pause, or ask. Yeah, if we are short, we can try to buy or we can stay. We cannot sell more. Yeah. Or if we are flat, we can do everything according to some probabilities. And if we are long, we can only stay or we can only sell. Yeah. And these quantities P1, P2, P3 are basically the probabilities of going for this action. And the goal of a reinforcement learning agent is to learn these probabilities. So we allow the stochastic policy in this case, meaning that in given state, with some probability we can go bid or we can pause. Yeah, this is how we define our action, how we define our state, and this is how the policy looks like. And the reward in this case is essentially our P&L, which include transaction costs. Sorry, how much time? Okay, we are clear now the time. So can I have maybe half an hour or so? Yeah. Sorry, I'm a bit lost in time. So maybe we'll have 20 minutes more to finish the talk. Yeah, but feel free to do your business. All right. So this talk will be recorded and it will be posted, so you can watch the remaining part of the talk online. Yeah. So reward. A reward is defined as basically difference in prices. So if we buy something, we need to remember at which price we sold, yeah, and just calculate the spread. Plus we have transaction fees, and the opposite with the selling. Yeah, if we sold something, we need to remember at which price we bought the contract, and then just calculate the difference, and then add to this spread the transaction costs. Yeah. So in these simplistic terms, our expected reward matrix looks like here. Yeah. So if we were short and then we buy something, we have this spread plus transaction costs, and we weight this P&L by probability. Yeah, because this is expected reward function. Yeah. Okay, and yeah, the rest of the matrix is basically the same logic. Okay, this is a market making example in kind of simplistic terms. Let us move forward and go to the optimal hedging example. So objective of this example is try to find optimal hedging strategy to hedge European option. And so pretty much task which is already solved without need of reinforcement learning. We know that in continuous time and without transaction costs, the optimal strategy would be delta hedging. But what reinforcement learning brings to the plate is that we can try to find optimal strategy when we have discrete times, which is more realistic, and when we have some transaction costs. Yeah. let us see how we define the problem. First, at the bank or investor, we want to optimize our final portfolio, final wealth. Yeah. So we want to, at the end of the trading day or at the end of the maturity, we would like to have some positive expectation, and we would like to minimize our variance of the portfolio. Yeah. This is our assumption. This is what as a trading agent, what we are care of. Yeah. And we would like to maximize this quantity here. The idea that we will try to implement in reinforcement learning is that we will split this total reward function in between individual rewards, so that we could get the individual rewards at each timestamp. Yeah. And the idea of this slide and next slide is how we actually arrive to this splitting. So first, we assume that the individual incremental rewards are independent, so that the variance of the final portfolio can be decomposed into the sum of variances of individual rewards. This is our assumption. And then, given that assumption, our individual rewards can be defined as this quantity here. Yeah, because we can split now the variance into the sum of variance. And it has been shown in one of the paper by Ritter in 2017 is that basically we can remove this quantity here, and individual reward function would become as increment minus some weight times increment squared. So this is how we move from the total reward to the individual reward. But now we need to define what is individual reward is and what is individual WT means for us. So now we consider the hedging portfolio, which consists of the our normal settings consists of some cash invested in bank account and something invested into the stock. So basically, our hedge portfolio is number of stocks times the price of the stock plus money in the bank account. And the purpose of this hedge portfolio is to replicate option and to avoid total and to avoid the variance of the total portfolio. We will be using the self-financial condition, which means this equation here. So in next time period, the hedge portfolio can only be constructed from the previous portfolio where bank account is increased because we invested money and we can get some interest rate on that. And this quantity here, which is previous position in the stock price times current stock price. So we can rewrite this equation as in these terms, where the next bank account is dependent on the previous bank account and some actions here. And then if we use the initial investment condition times 0, if we plug in the this self-financial condition into the if we basically plug in for all times t, if we plug in if we basically expand this equation number 8, we'll get this formula here. So we basically represented our final bank account as some combination of previous actions and previous number of our previous positions and previous prices. And then we are doing this in order to express, in order to represent the hedging portfolio as some combination which lacks the bank account. And then after some manipulations here, we are arriving into this sum of individual rewards, let's say. Yeah. So you can see we are always trying to decompose final wells, final portfolio, or final hedge portfolio into individual sum of individual increments. In this case, the increment looks like this, yeah, where each head is dependent only on the price, previous price, position, and previous position. Yeah. And then now we are ready. After we represented the hedge portfolio, we now ready to look at the total portfolio. Total portfolio, I mean portfolio of option plus premium and minus the hedge portfolio. Yeah. Or the opposite, sorry. Oh yeah, the opposite. The hedge portfolio minus the option. So the total portfolio in the end looks like that. So we get some premium at time 0, and then we can invest this premium. And then we also have the option value at the maturity, which is our payoff. And we have also constructed hedge portfolio here. Yeah, and the idea again to decompose. So we have now hedge portfolio decomposed. We now need to decompose this quantity here. And basically we do a simple exercise by creating some terms here, which are basically canceling out. But by doing so, we can arrive at this quantity here, which is individual increments of our total portfolio, which depends on the option prices, difference in option prices, and difference of the positions. Yeah, so we can see that individual rewards are now dependent only on the current time quantities and quantities at previous time. And this is how we define our rewards function. There are some manipulations, but I mean, all that we've done so far is just we decomposed our total portfolio into sum of individual increments, because this is a very comfortable setting for reinforcing learning, and this is how we can define our reward function. Yeah. So, and now we can simply define our state value function, because by definition, state value function is just expected sum of the reward, given we are in current state. And what are the advantages of such approach is that we can also add any form of cost function. Yeah. So far we were assuming that we don't have any cost on the transactions, but we can easily add any form, linear, quadratic, any form of cost function simply by adding this function into the individual reward term. You can see that the cost function depends on the price. It depends on the changing in the position. Yeah. The more is this change, the larger are the costs. Yeah. So the approach of reinforcing learning doesn't depend on the particular choice of cost function. The agent will be able to find optimal strategy with any cost function. And now let us say a few words about the environment in which the agent will be hedging the option. So we assume we have two assets, stock price and bank account. And the stock price evolves with geometric Brownian motion using this process. We have constant risk-free rate. We have some transaction cost function, which is dependent on the change in position and also the current price. Now it's just slightly in different terms, the stock financial condition. It's the same as previous one, but just this quantity here, which is obviously the transaction cost, because we need to include into that condition the transaction costs. And then we also assume that the prices of the derivative, or in this case the option price, is given as this formula here, which is just like a shows. Yeah. So approach that we are using here needs to have the option prices, because the option prices are part of the reward. Yeah. The way we define the reward is dependent. The reward is dependent on the option prices. But in these settings, the agent will be able to learn the optimal hedging strategy. Okay, and now if we again come back to the reinforcement learning settings and try to formulate the state, action, and reward, we will define the reward, the state as time to maturity, current stock price, and current position in these shares. For implementation purposes, just to have better numerical stability, we'll replace the simulated stock price by simulated Brownian motion. Yeah. So there is one-to-one correspondence between stock price and Brownian motion, so we can easily recover one from another. Action, given current state, would be the shares, number of shares at next state. So we simply try to find what would be the optimal number of shares we need to have tomorrow in order to replicate the portfolio, the option, in order to replicate the option. Yeah. So we observe the current price. We have the current number of stocks in portfolio. We know the time to maturity. And the idea is how many stocks we need to buy for tomorrow in order to have the portfolio hedged. And the reward function we just defined, individual reward function, would be this quantity here, which is basically sum of that quantities here, which and this the individual reward function depends only on the current position, next position, current price, next price, and the current and next option prices. Yeah. The agent doesn't absorb option prices. The agent gets the option prices as part of its reward, right? So the agent doesn't have any reference to the option price or option delta. So we'll see that the basically the only looking into these three quantities here, the agent will be able to find to replicate data strategy, essentially, something similar to data strategy. Okay, and these are experiment setting for the experiment. So we have maturity 30 days. So every day the agent has to the rebalance portfolio. So we have 30 steps. Our assumption in the drift in simulation process is defined: risk-free rate, volatility of the process, starting price, strike, and this is risk aversion parameter, right? How much weight we put into the variance of the final portfolio. So if you run 20,000 episodes, we run this number of episodes. But back to the question of how to find optimal policy, this is settings where we have continuous action space, meaning that action could be any number essentially between 0 and 1, because delta is essentially any number between 0 and 1. So we have to use policy gradient methods in reinforcement learning. And we choose, for that problem, we choose actor critique policy gradient method. Yeah, we will discuss these methods more in MLI course, just maybe to give you an idea of what these methods are doing. So we have actor and we have critique. Actor is making some actions, and critique evaluating all these actions. So it's like a child and parent. Child try to expose the world, and parent is telling to the child which actions are good, which actions are better, which actions are worse. And these actor and critique are represented by neural networks. So we have actor critique methods to find the optimal policy here. We're running 20,000 episodes, and just to show you some results. So the top plot is about convergence of that method. So we have moving average of cumulative reward. So final reward we just defined as a sum of individual incremental rewards. And the plot is essentially moving averages of that rewards, because it's very noisy graph if we just plot individual rewards, total rewards. So we have to do moving averages of them. So, but you can see there is convergence to something. So the agent learns over time, playing different episodes, what are the optimal policy. And the bottom plot is about comparison the learned strategy against delta hedging. So, and you can see, for example, path number 2 here, or path number 3 here. Path number 1, sorry. The red line is our data, meaning that we have another agent which basically every step does delta hedging. And the green line is actor critique policy, which we just learned. So, and this is stock price in the black. And you can see that the actor critique method learned something very similar to delta hedging. Yeah, if we look at the other plots, so it's kind of behaving similarly to delta hedging, but still differently, because we have discrete time, we have transaction costs. So, so yeah, these are comparison against delta hedging. Yeah, and that's it for today's talk. We covered three examples: order execution problem and market making problem, and optimal hedging strategy problem. If there are some questions left, please feel free to ask now. Thanks, Adam. Reference to those problems. So last problem is based on the paper. I can send the link. So do we have the email addresses of the participants? Yes. How can we share them? Okay. So we'll also we include the recorded video and include some references to the yeah. I will do that. Okay, looks like. Okay, if there are no more questions, thank you very much for your time. Yeah, and please feel free to to look at MLI course, because we will be discussing all the techniques and all these examples in more details in that course. Besides other topics, obviously, it's just a part of it. It's not just we'll be discussing not just finance problems, but all other problems in reinforcement learning, like standard open AI gym problems, and many other topics. Thank you very much for your time.